In this short video, we're going to answer the question, what exactly is the futures and commodities market? Why would I want to trade it? And what are the primary differences between trading stocks, futures, and Forex, along with the advantages and disadvantages of each? First and foremost, the commodities market, also referred to as the futures market, is the central location where the world's food, energy, metals, interest rates, bonds, and stock market indexes are traded and hedged. It's what we refer to as the last bastion of true capitalism on Earth today. Let's talk about some of the advantages of trading commodity futures versus stocks. And of course, we don't want to forget about Forex or foreign currency trading, so we'll also discuss that market as well. First of all, let's clear up some confusing terminology. What's the difference between futures and commodities? Really, there is no difference. The fact is, a futures contract is an agreement made between buyer and seller of the underlying commodity to either make or take delivery of that commodity at some point in the future, which is why we basically use the term interchangeably. Commodities are traded on exchanges, just like stocks. Stocks, of course, are traded for the most part in New York City, while commodity futures are traded primarily out of Chicago. No rivalry there. Traders who specialize in commodity trading like to think of themselves as the cowboys of the financial industry, and they see stock traders as those stuffed shirt executive types who rarely know how to go out and have fun. Of course, that's just rivalry talk again. Both markets are amazing. They both have some wonderful characteristics, but have been designed for somewhat different purposes. Although many traders do short-term trading or day trading in the stock market, the futures market lends itself to this type of trading much better. Let me give you a couple of examples why this is. In the stock market, we have what are known as pattern day trading rules. If you're already familiar with pattern day trading rules, then you know that, for example, to fly under the radar and to avoid the stock market pattern day trading rules, you must maintain and cannot fall below $25,000 in your margin trading account. This is not the case in the futures market. In the futures market, you can open an account with as little as $5,000, and the only minimum balance limit you must maintain is enough money to cover the margin requirements of your current positions. In the stock market, if you have less than $25,000 in your trading account, and you then execute 4 or more day trades within a 5 business day time period, then you are considered a pattern day trader. If you break these pattern day trading rules, your account is then suspended for a period of 90 days. It's like being put in the penalty box for bad behavior. As a day trader in the futures market, there are no such penalties whatsoever. You can be as active as you want, completely penalty-free. Another pattern day trading rule within the stock market that does not exist in the futures market is the problem of buying into or taking a new position using the proceeds of a previously closed trade. For example, if you sell a stock and profit $500, you are not allowed to re-enter or take a new trade using that $500 profit until tomorrow. In the futures market, that's considered ridiculous. And in fact, in the futures market, if you have a $500 profit, you can actually use that profit to trade or take another position without even closing out your current position. Go ahead, use your unrealized gains to make additional trades. Like I said, the futures market is the last bastion of pure capitalism on Earth today. And that's a perfect example of what we mean. How would you like to have your stock account frozen for 90 days just because you closed out a trade and got into another position on the same day? Don't break the rules or you're banished to the penalty box for 90 days. Let me give you one more example where the futures market far outshines the stock market: going short. What does it mean to short the market? Simply put, it means making money when the market falls, or selling first and buying back low later. In the stock market, the prospect of taking a short position is full of pitfalls. You must first borrow the stock that you're shorting, which means you have to pay interest on the borrowed stock, as well as you're responsible to pay out the dividends if the stock pays dividends while you have your short position. Who wants that? I have to pay interest and dividends to short a stock? No, thank you. Again, this is not so in the futures and commodities market. There is no penalty, interest, or dividends that must be paid to take a short position. We can go short just as easily as we can go long. Do you think the market's going to rise? Buy low first and sell back higher later. Do you think the market's going to fall? Sell high first and buy back low later. Just to reiterate, there are no pattern day trading rules within the futures market. And for that matter, there are no crazy rules like that in the Forex market either. Which brings me to even one more reason for loving the futures market. Within the futures market, we can trade all of the major currencies as well. We don't need to have a separate trading account with a Forex firm just to trade the currencies. By the way, did you know that we have mini and micro trading in the futures market, designed specifically for new or small account traders? And don't get me started on taxes. You do know that when you file your taxes when you trade the stock market, that you have to report every single trade that you made, in and out of the market, to the IRS. Yep, every single trade. In the futures market, we provide the IRS with two numbers, our account balance on January 1st and our account balance on December 31st. That's it. Oh, and we also get a two-tiered tax rate that's not provided to stock traders. We call it the 60-40 rule, where 60% of our earnings are taxed at a lower tax rate, somewhere between 0 and 20%, while only 40% of our earnings are taxed at our normal income tax rate. That's pretty cool, right? Where systems fail, methods prevail. This is our favorite saying here at Commodity Trading School. And during your online classroom experience, you'll learn how you can computerize your trading through the use of automated trading tools, where the software can actually execute trades for you, but where you still remain in complete control of the trading strategy at all times. These are just a few of the many reasons why we love trading commodities. If you would like to learn more about this amazing market and how you can actually start trading for a living, then visit our website online at commoditytradingschool.com. Learn from veteran traders. Let them do the market analysis for you and have them bring your attention to upcoming market opportunities. Watch and learn how to position trade, day trade, and trade with options. It's all right here at commoditytradingschool.com.